You're listening to New Retirement Radio, brought to you by the team at Prout Financial Design.
Hello, I'm your host, Certified Financial Planner, Dennis Prout.
I'm Heidi Cartwright, Financial Advisor and RICP.
Advisors associated with Prout Financial Design may be either 1. Registered representatives with and securities offered through LPL Financial, member FINRA SIPC, and investment advisor representatives of Integrated Partners, a registered investment advisor, or 2. Solely investment advisor representatives of Integrated Partners, a registered investment advisor and not affiliated with LPL Financial. Investment advice offered through Integrated Partners, a registered investment advisor. Integrated Partners and Prout Financial Design are separate entities from LPL Financial. Dennis Prout and Nathan Prout are solely investment advisor representatives of Integrated Partners and are not affiliated with LPL Financial. The opinions voiced in this show program are for general information only and are not intended to provide specific advice or recommendations for any individual. To determine which strategies or investments may be suitable for you, consult the appropriately qualified professional before making a decision.
WTCM News Talk 580. Good Thursday morning. It's 10:08. Time for New Retirement Radio with Prout Financial Design with Mr. Dennis Prout. Good morning, sir.
Good morning, Ron. I'm sorry. I'm still laughing at our previous conversation before the show began, but we're not going to repeat that here now. It's so great to have you here with us on Thursday, May 8th, 2025. Can you believe it?
Wild.
It's wild stuff, Hal. And just looking now, I've had friends say, Dennis, please don't talk about the weather. Everybody's talking about the weather, but I actually took a picture of the forecast because the sunshine and the temperatures steadily gain. Looks like Sunday 72. Anyway, sunshine. Repeat some more. We'll take it. It's great to be here. Now, joining us, too, is Heidi Cartwright, our own RICP and Managing Director. Good morning, Heidi.
Good morning, Dennis. It's my pleasure to be here. And I say we should talk about the weather because these are the days that we live up here for. It is beautiful outside. Yes, indeed.
We'll take it. Yeah, it's way too nice. And Beth Shire, our own Director of Marketing. Good morning.
Good morning. It's good to be here. Welcome, everyone, to the show. And I do want to say, the birds woke me up at 5 o'clock in the morning, and I wasn't even mad about it. It was beautiful.
That's cool.
That's when you know it's spring.
Yes.
That's cool. Now, the sun rises. It was well up at 6:45 this morning. I don't know what time it goes up, but it seems like it's up till about 9 p.m. as well. So there goes our long days. We'll take them. Yep. It's great to be here. Great to be here. Now, today we're talking about tariffs. What's next for stocks, bonds, and the dollar? The dollar. What are we going to do about all this? And some great info from both our economic advisor as well as Capital Group, and we're going to try to include both of those. We're going to try to be inclusive. And if you do have a question of a financial nature, we'd love to try to answer that. Our phone number here, if you would, Ron, and or text.
Same number for both methods for reaching out, 947-0023, 231 area code 947-0023.
Yes, great, thank you. As investors evaluate their portfolios and asset allocations, they will encounter a few new paradigms in the coming years. No kidding. There is enough... I couldn't think of a better word, cacophony, if you will, out there of noise. I just repeated that. It's a cacophony of information or headlines out there about all of the issues related to tariffs. I guess this morning it was announced that we apparently have a deal with Great Britain. And, we'll see what that bears. But there is a lot of noise out there. Several portfolio managers, Capital Group says, and economists share their views on the potential implications for the economy. I refer to this as the good, bad, and the ugly. And, of course, trying to guess the future can be very interesting indeed. But they are saying the risk premium on stocks will likely be higher. It simply means they're saying prices could be somewhat compressed. It may still be a difficult headwind for the market. A derating hits everybody, but some more than others, economist Daryl Spence says. In a world of higher inflation, maybe slower growth and deglobalization. Do you go back to a PE ratio, say a multiple of 22? Probably not. Maybe 17, 18 is okay. What they're simply saying is they anticipate, again, prices to be compressed and or to be volatile. Surprise. Is anyone surprised at any of that? Consensus earnings projections for the S&P 500 companies have dropped by more than 3% over the last 4 months. Earnings for the S&P 500 are forecast to grow at about 11% for 25. Still not bad. Now, what's interesting is the reports that S&P 500 companies have had in terms of their earnings have been about 75% ahead of estimates. So, I should say 75% of the companies have been ahead of their estimates in terms of their reports. And the market has been relatively resilient in this. And in essence, while the correction was relatively significant, sages such as Warren Buffett said it was basically nothing more than a drop in the pan or a drop in the bucket, if you will. He wasn't that upset about it at all. He remained nonplussed.
He pulled a lot of his money out of the market, though, didn't he?
Yes, he did.
Yes, he did.
Mm-hmm. Mm-hmm. Both the S&P 500, Apple, computer, among others. Thank you very much. Consensus earnings projections, again, 11%. There is a silver lining despite the current market turmoil. Keep in mind that this has been a policy-driven market decline. Let's talk about that, shall we? Not a sell-off due to weak corporate fundamentals like we saw in the dot-com bubble of 2001, 24 years ago. Yeah. With me? Okay, great. Or the home mortgage meltdown of 2008.
That was policy.
Oh, my gosh.
We remember 2008.
That was a barn burner crusher. That was so crushing. The market was at 14,000 in October of 07. And March of 09, it was 6,800, 7,000. Wow. It was brutal. It was a takedown.
Yeah. Ouch.
Yeah. Weak markets can create great opportunities. Says Chris Buckbinder. Weak markets can create great opportunities to buy good companies at even better prices. That's basically what Warren Buffett has said. When you can buy these companies trading on the American landscape at a discount, you may want to jump in. Yeah. This is generally what we're seeing. I wrote as my own note. That's what we're seeing in terms of those we respect, those who tend to be veterans of this sort of thing. And for those others who have already stayed with it, we're recommending you continue to stay with it. Obviously, it presents opportunities for diversification. That goes without saying. This is part and parcel of the conversation today. The importance of diversification. We have seen it in our portfolios, in our clients' portfolios. Yes, sir.
I just want to make an observation. Microsoft, I looked up randomly at stock, and after the tariff announcements, Liberation Day, they dipped down to $354 a share, and they're up now to $437.
Yeah, a dynamic increase in total price.
Yeah, so that was I guess the point, you tell me if that's right. People were saying when the market dipped, it was a good time to buy some stocks.
Yeah, like good, solid companies like Microsoft, Google, and others. Many had said, just because you brought up the name, thank you very much. It's helpful, And am I saying that it's a great time not to buy? No, not at all, because I can't say that as a general piece, but averaging in, buying generally when prices are weaker can, thank you, Dennis, can be a good investment theme to pursue. Yes.
It's sort of like that idea, buy low, sell high.
Yes.
Type thing.
And buy low and lower in some cases. Now, some of that didn't work. Let's talk about that, too, because the price even went lower. Just when you thought it couldn't go any lower, in some respects it did. And I see you have gold pulled up there, too. That's just so radical to watch that booger. It's amazing what some of this is going on. Who would have predicted? Did anyone predict that gold was going to be at, 33.63 here this morning on May 8th? Not many. Given a year and a half ago, maybe 2,000. I don't have it right here, but it's amazing what increase we've seen in the last 5 and 10 years for the metal. It's done better than the stock market. So that's one great way to highlight the appropriateness of diversification in this world we live in. And what's interesting is the individual investor has stayed really quite strong in this whole transaction and this whole correction downward. 2, international equities have new catalysts. The recent downdraft in U.S. equities, and the reason I say that so succinctly, if you will, I'm trying to hopefully help you guess what the heck it is I'm saying, okay? The recent downdraft in U.S. equities is bringing renewed focus on international stocks. Over the last few years, their cheaper valuations than similar U.S. businesses have been the main argument in favor of international equities, but other catalysts are coming into play. Now, what's interesting here, Ron, just because you don't have it, I'm going to pull up this graph here for you so you can see.
I see.
You can see that downward shift
it's
there.
A downward shift. I'll testify to that.
It's significant. It is a 20-year low, according to this, in terms of the international markets versus the U.S. It would or could potentially indicate better value for international equities. So for those who are willing to have some exposure to international right there, there's an opportunity to invest in a broader market and spread your wings, as Johnson says from Capital Group, been with them for 25 years. Seems like forever. Brazil may find increased trading opportunities with their agricultural trade because of the shutdown, if you will, from China. So there are a tremendous number of potential opportunities for those who would like to invest and diversify their portfolios internationally. Next, 3, don't count the dollar out just yet. The U.S. dollar. The U.S. currency's safe haven status and a structural decline is on the horizon potentially. It may be premature to call it a regime shift. They're saying, don't count the United States out just yet. In short, what they're saying is U.S. Treasuries. Oh, excuse me, that's not where I wanted to go. Here it is. There is a lack of large liquid alternatives for investors seeking to diversify away from Treasuries, United States Treasuries. It also appears as though the Trump administration is sensitive to moves in the bond market, as they need low and stable rates. What they're saying about the United States is it remains the world's largest economy with deep financial markets and checks and balances built into its institutions. Moreover, the lack of many alternatives around the world, whether it's the U.S. dollar as a reserve currency or U.S. Treasuries as a safe haven asset, U.S. financial assets have a remaining underpinning of support. So that is a lot of wordage there. I get it. But again, what they're saying is diversify overseas, but don't count the United States out because of the checks and balances, because prices, in essence, are still more conservative than they once were. And our growth potential remains relatively stable. Relatively stable.
What's the importance of the dollar internationally and having it be the main currency?
Well, it's the underpinnings of our own ability to trade with foreigners. It's our ability to borrow money overseas, to have that faith and trust in us and our ability to repay our debts. Just because you brought up our debt service that we're at, 37 trillion or whatever it is.
Something like that.
Yeah, our position as still the leader in the world in terms of our own market and economy. That's why the dollar is still at the pinnacle that it is, but it is losing value compared to other currencies. And that concern is related around our own economy, the cost of tariffs, number 2, and also in our ability to repay that debt. all of a sudden that seems to me, and I say seems, to me to be a conversation that is being more written about. We are going to have to pay that debt back to maintain that trust or that faith in our own currency. It's not as though Congress can continue to spend at such a rapid pace, because eventually the full faith and credit of the federal government will come into question, as even Warren Buffett alluded to. And he said, I thought this was fascinating. He said, listen, the federal government is going to have to deal with its debt, and I don't admire those who are trying to help us do that. So he was alluding to, I think, the whole DOGE thing, the Department of Government Efficiency.
Yes.
As a part of that. So, I'll just say this, some of the most responsible economists and business people are referring to the debt as an overhang. The cost of interest alone is more than our defense spending. It's significant. And eventually it has to be paid for, yeah. So all the spending that went on, it's an overhang right now. That's one of many reasons gold has ascended as it has in price, because there's more uncertainty regarding the dollar. 4, U.S. economic growth will slow. The U.S. economy risks further slowdown the longer uncertainty persists around tariffs. We're starting to see that in some of the imports, and their increasing prices and their ability to handle it, companies' ability to handle that increasing price from China, and their, the supplies that come over from the Chinese. Mm-hmm. Last, bonds will see a price adjustment, not a full-blown crisis, according to them. U.S. treasuries will likely continue to be a store of value, is what they're saying, in short. So still, diversification remains supreme. Keep in mind that tariffs, the concerns around those may be somewhat overblown in some cases and somewhat missed completely in others. We don't know the full playing field yet. All of us are trying to figure this out, what this is going to mean. And especially companies who trade with the Chinese and other foreigners and trying to figure out how to reprice their goods and services. They're scrambling right now.
Yeah. Christmas will be interesting.
Yeah.
It will be.
So President Trump, article on Yahoo.com, says he's ready to announce a trade deal with the UK, the first of many, he says.
Mm-hmm.
And his Treasury secretaries in Switzerland this week is going to open up talks with the Chinese on tariffs. Yeah. So is that seen by the market as good news?
It is. There was a great piece that we've got. Look at your stuff there, Dennis. Here it is. Chinese delegation spotted entering Treasury Department. An overnight report in the, I'm not sure how to pronounce this, the Jungang, one of the 3 biggest newspapers in South Korea, confirmed that the United States and China have begun behind-the-scenes contacts in relation to the tariff war waged by President Donald Trump. So they've been having ongoing conversations, and that is really the case.
Even though the Chinese say they're not talking.
Yeah, don't listen to them. Lastly, I have a wonderful quote, turning down the heat maybe and the intensity of the conversation. This is from, it's 100 quotes from Charles Munger, Warren Buffett's former partner. And I really like this. I don't know if I've mentioned this before, but if I have, my apologies, because it's so funny. Charles Munger, an incredibly bright man, said this. A foreign correspondent, after talking to me for a while, once said, "You don't seem smart enough to be so good at what you're doing. Do you have an explanation?" Heidi, you're talking about equity strategy insights here from LPL Financial.
That's right. This is their newsletter, and their newsletter talks about investing in a period of heightened trade uncertainty. So going again into that topic that we've talked about several times, and Dennis just got through talking about tariffs. So it's difficult to make a tactical asset allocation decision right now because it's unclear where tariffs will end up, what trade deals will look like, and how global supply chains will shift, and what eventual impact on margins might happen. So they wanted to highlight some sector opportunities or opportunities that they see. They say that lower tariff rates may take a number of months to achieve. That 90 trade deals in 90 days they think is a pretty ambitious goal. And they say that it may take some time to work out these trade deals. But like Dennis was talking about earlier in the show, we had an announcement today from the White House that there is an imminent trade deal with the UK. So that seems positive. So to help us identify winners and losers in this environment, we break the rest of the year into two phases. The first phase is what we're in now, so what's happening today. We call it peak uncertainty and peak tariffs. The second phase will start once several trade deals with larger trading partners are announced and overall tariff rates begin to come down. In the first phase, the winners are the more defensive sectors, relatively insulated from tariffs. And in the second phase, the winners may be the sectors that benefit the most from lower tariffs. So what are those winners is the next question, right? Mm-hmm. Well, during phase one, the most defensive investments with the least amount of exposure to tariffs would perform well. So real estate and utilities fit that bill, and this is the first sector that they highlight. Markets rewarded these sectors for their defensive characteristics this year through the April 8th market low without performance of other investments out there. So, but there are some challenges for these sectors. It's not just going to be an easy way. One challenge for these sectors is a potential increase in rates. They carry high debt levels and are used by investors for their dividends. So the debt levels of those different companies could come into play. And utilities are likely an underperformer on trade clarity. So as clarity comes into the picture, some of the value of these investments may retreat. For real estate, the challenges include pressure on retailers from tariffs, work from home challenges for the office segment, potential reductions in data center investment, and sensitivity to a slowing U.S. economy. So what's another sector winner, do they think? And they think consumer staples. The tariff impact on consumer staples is mixed. On one hand, domestic packaged food companies are relatively insulated thanks to specialty crops. And these are things that would come from some of our near trading partners like Mexico and Canada because they operate under the trade agreement that was made USMCA several years ago, I think under the first Trump administration.
Mm-hmm, mm-hmm.
So this makes it less likely that grocers and other retailers with notable grocery operations will hike prices on perishable goods. So that seems to be a positive for that sector. They do say, on the other hand, that dollar stores and super centers are not immune to a reliance on goods from China and will be forced to raise prices or adjust their supply chains after inventories start to deplete. So they're saying your local food is not going to be affected as much as maybe some of those that rely on China for those low-cost goods coming into the picture. So what is the third sector? And this is something we have noticed, Dennis and I, is gold. Gold is another winner during phase one. The commodity typically benefits from policy uncertainty, but add a whiff of stagflation from tariffs and the U.S. dollar, and you have the ingredients for one of the biggest rallies ever in gold prices. Gold has reached extremely overbought levels, and after a pullback, adding some gold exposure for those may make a lot of sense. So what they're saying there is prices for gold are at the top right now. We've seen a a great increase in the price of gold so far this year. And so buying now, you just want to think about that. But at any pullback or weakness in gold prices, it might be something that you would want to consider if you don't already have it within your portfolio.
Yeah, when you look at the graph related to the price of gold, it looks parabolic right now, and parabolas tend to collapse at some point, and that would not be surprising. But guessing the price of gold, many really good money managers gave up long ago trying to guess where the price of gold was going to go, but it does look parabolic at this point.
What historically, is there any reason where there would be a sell-off in gold?
Yeah, well, you could simply put, you've got more sellers than buyers, people taking profits because they see the same thing. They're concerned about the prices. Others may be more stability seen in the markets. Maybe the tariffs deals start to come through more consistently, and more concerned about the U.S. dollar declining, or rather the concern itself declining.
Yeah.
There could be several reasons why gold would decline. Go ahead, Heidi.
Oh, okay. So some other thoughts that they had on winners for phase one. They say it would be logical to put the defensive healthcare sector among the phase one winners. But pharmaceuticals are in the crosshairs of this trade policy. Pharmaceuticals make up the bulk of the sector and are one of the most imported products for the U.S. So that is going to have an impact as we have tariffs. On the manufacturing side, they note that India has steadily gained share in the generic drug market. India is poised to become a prime location for supply chain relocation from China, and a trade deal framework is reportedly imminent.
Isn't that interesting? I mean, the competition globally and worldwide is so significant that many times the adjustments that are made behind the scenes are surprising. So that's why you and I'll speak to myself too, always need to moderate, if you will, what you're reading in the paper or in the news about what is going to happen, because the adjustments made behind the scenes by companies, countries, and or the ability of production to occur elsewhere than what it currently was, if you will, can be dramatic, and that change can happen really quite quickly.
Mm-hmm. And then one more final comment on the healthcare side, Dennis, is that they say that on the medical equipment side, tariff exposure is relatively limited, which surprised me a little bit. And they say that 12% or less of the revenue of these types of companies is based in China. So that they're going to be less affected by any tariff war with China.
It's interesting, the amount of information we're getting, and it's helpful, but trying to disseminate it to you, our listeners, we take a great amount of responsibility for it, and it, of course, at any point in time, our information could be dead wrong. We were talking about this before the show. In that conference we attended back with TD Ameritrade maybe 10 years ago, and they were saying that individuals would be selling their power back to companies because there would be an oversupply of power. Well, it's amazing to me still how wrong they were in that. In spite of all the technology and all the rest, well, technology is driving the need for power beyond
needs even more power.
Limits that we never thought would be happening. So. All right.
That's where that crystal ball would really be great. If
you
could find one that worked.
I could say, I'm sorry, you're wrong, but yes.
All right, so now let's talk about phase two. So phase two, if you remember, is after the trade deals are signed and the tariff rates settle in. So what are the opportunities seen by LPL in phase two? Well, they say communication services. According to Bloomberg analysis, the communication services sector has the highest percentage of cost of goods sold sourced outside of the U.S. among all of the S&P 500 sectors. The key risk beyond regulatory pressures on big internet companies is that tariff rates don't come down as much as anticipated. So what they're talking about here is because so much is located outside of the U.S., once those tariffs are decided, we might see some stronger markets or stronger prices in the communication sector because there'll be some resolution. Whereas now, it's more uncertain,
yes.
and there's a lot of uncertainty out there. Now, technology has been the best performing sector since the April 8th low, suggesting it deserves consideration as a phase 2 winner. The sector could easily grow earnings 20% this year as AI investment continues. But our technical analysis work reveals a mixed picture. The sector has underperformed since July of 2024. We also worry about semiconductor industry disruptions from the U.S.-China trade tensions. And I know that we've talked about on the show the investment from Taiwan in the semiconductor field that was announced recently, bringing some of that production to the U.S. shores. So we'll see how that impacts us as well.
Yeah, so Beth, stats for the week. What do we got?
We've got a couple here. IBM has announced plans to invest $150 billion into the U.S. over the next 5 years, which includes a $30 billion investment in research and development for quantum computers.
Wow.
It's from Reuters. And DoorDash, a U.S.-based meal delivery service, has submitted a $3.6 billion buyout proposal to Deliveroo, a UK-based meal delivery service, causing Deliveroo's share price to surge on Monday.
Wow. I didn't know DoorDash was that big that had the kind of money.
It's incredible. They just blew up.
DoorDash.
I mean, yeah. And then we have, this is a funny one, 48% of teenagers 13 to 17 years old believe that social media sites have a mostly negative effect on people their age. No surprise there. This is up from 32% in 22. However, only 14% of these teens think that social media negatively affects them personally. So they're not the one with the problem.
It's negative, but it doesn't affect me.
It's not me, it's you. And then we have New Hampshire's new law. Actually, I have no idea. I'm not good at that accent. I don't even know what that is. So anyways, New Hampshire became the first state to pass a crypto reserve law. The state will now be allowed to invest a portion of its public funds into crypto and digital assets. Other states like Florida and Arizona are working to pass similar bills, but the new law comes with certain rules. The state can only invest up to 5% of its public funds into crypto, and cryptos have to have a market cap of $500 billion for New Hampshire to buy it. So that was very interesting. That's from Market Briefs.
New Hampshire. Live free or die is their motto.
Talk about a volatile asset.
Right.
It's crazy.
A couple of questions or comments here. What happens if the USA defaults on the interest payments?
Well, it would be, I don't know that it would be Armageddon, but it'd be something like that. It would be incredibly short-sighted.
If anything,
it's not as though it hasn't happened to governments around the world in the past, but it would be, for right now, it's a non sequitur, incredibly unlikely. But if they did get to that point, it would mean that other countries would step up to take the lead in terms of their currency and their economic leadership, representing the world as the new leader. And that did happen to Great Britain years ago when the United States took over as the major world leader in economics and its own currency. Yes. So those things do change over time. The concern is, we may be seeing that change to us over the coming years, given our inability to control our spending, which often happens with countries in our position. This is nothing new.
All right, one comment here. China is supporting India against Pakistan because of the companies relocating. Because India and Pakistan have a little dust-up going on right now.
Oh, yes. Yeah. It's quite disruptive there. Absolutely.
And one other comment. The remaining problem with moving pharmaceutical production to India is that most of the ingredients for genetic and overall the counter drugs still comes from China.
Yeah.
And one other compliment that says here, thank you, Dennis, Heidi, and everyone at Prout Financial Design. We are living our best retired life currently in North Carolina, about to hit some awesome whitewater in our kayaks.
Oh, my gosh.
That is really nice.
Isn't it?
That's got to
That's
be
very
Chris
kind.
and Mary. Chris and Mary, thank you for listening.
Oh, so you know
my
who
gosh.
that is.
They're they're avid kayakers, if this is the ones that are speaking, and my gosh, they travel all over the world kayaking. And their favorite place in Michigan is to come up on the Boardman and kayak here because of its challenging water. Talk about fun, eh? What a great way to stay at it. So we applaud them, and man, what fun to hear. You bet. One thing I thought was interesting that I alluded to from our own economist, Rob. By the way, how much time do we have here?
About 3 minutes.
Excellent. Since 1928, the average intra-year drawdown in the S&P 500 is 16.3%, negative 16.3. So far this year, we've had a 19.7% decrease.
And what is that? In the what?
Since 1928, the average mid-year, intra-year drawdown for the S&P is 16.3%. So far this year, we've had a 19.7% decrease. That was at the height of the decline.
Yeah.
Is that an oxymoron? Height of the decline? That's not out of line with normal stock market price fluctuations. Risk in the markets is ever present, but you don't get the reward without taking calculated risks. In the period ahead, he says, I will buy the dips. I will buy the dips. So it's another indicator of those who know such things and or follow such things very, very closely and make it their lives, if you will. Possibly this is helpful, that they're looking at these strong companies, which we mentioned earlier, to go in and buy when prices weaken. That would also be something that even Warren Buffett has alluded to, not specifically to any company, but just saying that their new CEO, Greg Abel, I think is his name, he said he wouldn't be surprised if he goes in and spends $100 billion buying up a significant portion of a company or all of it at some point.
That's a bit of money.
It is a bit of money. I believe Berkshire Hathaway owns more treasury bills than even the federal government itself. That would be possibly a bolster for those who are concerned about the United States not being the reserve currency or being able to follow through on its debt obligations. That, at this point, I would say remains a very distant threat.
Did they buy a lot of those recently?
That's been something that they've been adding to over, I would say, quite a few years here. Their T-bill hoard, if you will, treasury bills. Not exactly exciting, but the interest rates are really helpful at 4 to 4.5% or so, depending on the day of the week. That interest rate is short-term interest rates right now are extremely helpful for those who want to be more conservative as well and bolster the rest of their portfolio's returns.
All right, that will wrap up another episode of New Retirement Radio with Prout Financial Design in Traverse City, Michigan. ProutFinancialDesign.com. Mr. Dennis Prout, Heidi Cartwright,
Thank you.
and Beth Shire. Thank you all for being in today.